Look, the move we talked about didn't just happen. It played out step by step exactly how the setup said it would, and if you were watching close, Wednesday wasn't a surprise. It was a message. After that halt, silver didn't collapse randomly. It walked straight into that 87 zone, that 87.20 to 89 area we flagged earlier, old resistance turning into new support. And yeah, it caught a bounce back toward 90 like it was supposed to. But then reality hit hard. Rejection slammed price down to 85, and now it's hovering near 86 with that 150 EMA sitting right underneath like a last chance floor that's held before but isn't promised to hold again. And if you read tape instead of headlines, you already know this is a decision zone, not comfort. Folks, through this channel, we bring you the kind of updates no so-called expert is talking about. Not sure why, but a lot of people just watch quietly and still don't hit like or subscribe, and you don't even drop a comment to tell us what didn't make sense to you. Now, right as that's happening, boom, news drops that Jane Street loaded up 20.6 million SLV shares in Q4, stepping in as the biggest holder with a 1.3B stack, and that's not passive money parking for retirement. That's control capital. That's positioning to move volatility, not survive it. And before anyone gets cute, yeah, OG John AG here. Same handle you see on X and YouTube. And no, I don't sell anything, never have, never will. Scammers copy the style, copy the tone, even copy the I don't sell line. But the one thing they can't fake is the handle. So check it before you trust anything, because this game rewards verification and punishes laziness. Videos are tighter now for a reason. If you still can't sit through one, that's not length, that's attention conditioning. And that conditioning is exactly what this system feeds on. Because the truth is simple. Firms like this don't pile into size to bet on direction, they pile into size to manufacture reaction. When they accumulate enough inventory, they don't just ride price, they shape it. When retail gets comfortable and bullish, options skew cheapens, puts get ignored, that's when they load them quietly. Then one coordinated unload hits the tape, price snaps, stops cascade, panic spreads, and suddenly those cheap puts explode in value while retail scrambles to understand what just happened. Then they buy back lower, flip sentiment again, squeeze late shorts, trigger FOMO, and run the cycle back up. This isn't theory. Regulators in India already flagged similar behavior tied to expiry manipulation, alleging hundreds of millions in unlawful gains, leading to temporary market restrictions before conditional re-entry with escrowed funds, still sitting as the case plays out. Different geography, same mechanics. And don't think it stops at metals. This blueprint shows up in crypto too, where spot accumulation pairs with derivative pressure to create controlled crashes that look like news reactions, but settle like engineered liquidity events. So when you see them sitting on a $1 billion SLV position, ask yourself, is that a long-term bet or a volatility engine? Now layer in what's happening underneath price. Comex registered silver keeps shrinking. Lease rates that used to sit near zero are now spiking north of 1%, meaning someone out there is paying up just to borrow physical metal today, not tomorrow. Swap rates flipping deeply negative tells an even louder story. Participants are literally willing to give up yield just to lock in access to silver now and promise to return it later. On paper, that looks like free arbitrage, but nobody's scaling it, which means the real risk isn't price, it's availability. And here's where it gets uncomfortable. During that halt, over 31,000 contracts traded off-screen, representing massive ounce volume moving while retail sat frozen out. That's not glitch behavior, that's structural privilege. Add in the pattern. Halts clustering around delivery windows, open interest collapsing while physical premiums persist overseas, Shanghai trading consistently above Western spot. And what you're seeing isn't noise, it's separation. Paper price is being managed, physical demand is not. The system can tolerate slow climbs, but sudden velocity tied to delivery pressure forces intervention because momentum can break settlement confidence faster than contracts can be rolled. Meanwhile, miners aren't collapsing with price. They're holding strength, and historically that divergence shows forward expectations aren't matching current tape drama. India just opened institutional doors for hard asset allocation at scale, central banks continue stacking gold like insurance, and lease markets are flashing stress that sentiment charts won't show you. So yeah, algos can shake you out, halts can slow momentum, and contracts can be pushed forward to buy time, but none of that creates new silver supply. The game works as long as participants react emotionally to surface moves instead of tracking structural signals. Lease rates, swap spreads, cross-market premiums, that's reality. $5 intraday swings driven by liquidity dumps, that's theater. Know the difference, verify everything, and move with logic, not panic, because the ones who treat this like entertainment end up funding the ones treating it like infrastructure. And if you think what we just broke down is where it ends, that's exactly the kind of halfway understanding the system depends on, because the real game isn't just in the drop or the bounce, it's in the exhaustion that comes after. when people stop asking questions and start accepting whatever the chart prints next like it's natural weather instead of engineered pressure. See, right now what's happening isn't loud, it's subtle. And subtle is always more dangerous because it doesn't trigger panic. It triggers complacency. Price sitting in this mid-80s grind zone isn't weakness by default. It's conditioning. This is where traders get trained to stop expecting follow-through, to stop trusting breakouts, to start doubting every move until hesitation becomes the default response. And hesitation is gold to anyone running size because hesitation delays reaction, and delayed reaction creates predictable liquidity pockets. That's why these cycles stretch. Not because they can't move price fast, but because stretching time drains conviction. When conviction drains, participation drops, and when participation drops, control gets easier. Now look at how narrative starts adjusting right on schedule. Suddenly you hear chatter about healthy consolidation, about macro cooling, about demand normalization. Same move, softer language, same pressure, friendlier explanation. That's not coincidence, that's framing. Because once enough people accept the story that nothing unusual is happening, volatility can expand again without resistance. And right as that acceptance settles in, watch what starts building under the surface. Positioning shifts, not in the loud public data everyone watches, but in the quieter flows that don't trend on finance Twitter. Inventory lending tightens a little more, swap discomfort lingers, delivery chatter refuses to fade even when spot stabilizes. Those aren't headline drivers, they're pressure gauges. And pressure gauges matter more than candles because candles show you where price went, gauges show you what forced it there. Meanwhile, retail psychology moves through its predictable stages. First confusion, then frustration, then disengagement. By the time disengagement hits, volatility events don't feel shocking anymore. They feel annoying. And that's the sweet spot for anyone managing flow because annoyed traders don't defend levels, they abandon them. That's when stops stop clustering and start scattering, which makes engineered moves smoother and cheaper to execute. And while that emotional cycle plays out, institutional patience keeps compounding quietly because patience is the one edge that compounds without capital. Every day, price doesn't resolve builds optionality for those who already hold influence. Every day, retail attention shifts elsewhere, reduces resistance. That's why you'll notice how often momentum dies right before it would attract fresh participation, because attracting fresh participation increases unpredictability. Controlled systems avoid unpredictability. They prefer slow bleed to explosive shock unless explosive shock benefits positioning already in place. So the question isn't, why isn't silver moving yet? The question is, who benefits from it not moving? Because stagnation isn't neutral. Stagnation transfers energy from impatient hands to patient ones. And right when that transfer reaches a threshold, movement returns fast enough to feel organic, even though it was staged through weeks of silence. Now zoom out mentally, not on price, but on behavior. When miners hold relative strength, when physical access costs stay elevated, when off-screen volume shows up during restricted windows, when global pricing disconnects persist longer than arbitrage models would normally allow, those are signals of system strain, not collapse, but strain. And strain doesn't break markets overnight, it changes how they react under pressure. A strained system halts quicker, rolls faster, explains more, and resolves less. That's the pattern to watch. Not any single spike, but the growing frequency of interventions needed to maintain continuity. Because the more often continuity needs defending, the less natural the equilibrium actually is. And equilibrium that requires defense eventually tests its defenders. That's not drama, that's structure. So while surface chatter debates whether the next move is up or down, the deeper shift is already happening in how movement gets managed. Speed becomes the enemy, not level. Participation becomes the variable, not trend. Confidence becomes the target, not price. And when confidence gets managed, price follows in whatever direction serves stability first and narrative second. That's why emotional traders feel whipsawed. They're reacting to price while the system reacts to stability. Stability doesn't need rallies, it needs order, and order often looks boring until it suddenly doesn't. So if you're watching this stretch and wondering why nothing decisive seems to happen, understand that indecision is often manufactured, not accidental. It buys time. Time allows positioning to evolve without attention. Attention is the only force that destabilizes controlled environments, which is why distraction is always abundant when structure matters most. New stories, new shiny assets, new debates, all pulling focus away from the slow build happening where nobody's looking. And by the time focus returns, the build has already matured into movement that feels spontaneous. Nothing here requires panic or prediction, just awareness of which signals reflect sentiment and which reflect stress. Sentiment can be steered. Stress has to be absorbed, and systems that spend more effort steering sentiment than resolving stress eventually reveal their limits not through headlines, but through behavior. Watch behavior. That's where the real tell always lives.